Welcome again to another episode of Envirohation Podcast. My name is Wangeshi Karemi.
And this is Bikoro December.
And so far we have had different conversations. We've talked about climate change. We have tried our best to define what climate change is. And then we discussed different causes of climate change. And here we looked at the greenhouse effect and global warming. And then we talked about how individuals can contribute to climate change as individuals in your day-to-day practices. And here we talked about the carbon footprint. So in this particular discussion, we're going to be talking about carbon trading and carbon credits. We're going to try and understand a measure to try and solve climate change through financing carbon, taking it into the market and say, now people can trade in carbon. And we're going to try to define these things in the simplest way we know how. And we're going to see if we can get a few analogies by the end of the day. Now we hope you have fun. So the first question would be, what is carbon trading?
Well, as before we said, you're gonna simplify things, yeah?
Yeah.
So carbon trading, we're gonna split the phrase, yeah? So carbon on one end, trading on the other end. We already know what carbon is, our contribution to greenhouse gases. So that is carbon in the form of CO2 and CO. And trading, what is trading? Trading is the exchange of exchange of goods and services in a market. So essentially, when we say carbon trading, we're talking about how we're going to take this carbon as our commodity. That is, a commodity is a good or a service. We're going to take this carbon as our commodity and put it in the market and have it sold and bought.
Yeah. So when you talked about carbon footprint, we said every individual has the amount of carbon that they give to the environment, right? So sometimes you find in the event that you produce less carbon than other people, there's the way you can trade, yeah? So if you produce like 500 carbons and you are supposed to produce 100 units of carbon, and I am supposed to produce 100 units of carbon and I produce like 30, I have 70 to take to the market and sell. You are negative like 400 or something. So you need to buy my 70 plus others.
Yes.
So we're also going to be taking a look at the carbon trade, the limits that have been set and when and how they were set.
That is the limit to the carbon that you can
produce.
Yeah.
And when we look at it, we're not necessarily looking at it at this point from an individual aspect. Yes, individuals have individual carbon footprints, but just like you can calculate the carbon footprint of Bikoro, you can also calculate the carbon footprint of everyone in this room, including our very beloved cinematographer.
Yes.
Hata smile.
Wow.
Tunamfeature na hajali. Okay, sawa. So just to get into a few behind the scenes of how this came about. The idea of carbon trading starts from a guy called Arthur Pigoi. So, Arthur Pigoi is an environmental historian. Okay. Alright, so let's just explain what he saw. Arthur Pigoi noticed that when a consumer and a producer are in the market, there's normally externalities. Externalities are the benefits or the cost that a third party suffers. For instance, a very quick example. My analogies are back, Bikoro is the consumer of a product, and I am the producer. Our cameraman has nothing to do with this product. Let's call it a radio, for instance. I produce radios and then I sell them to you. You go play music in your neighborhood. Your cameraman is your neighbor. He suffers the cost of that music. He suffers the cost or benefits from it, whatever. It's just that he was a third party in this arrangement. He was not part of this arrangement. So in that case, that becomes an externality. When it's a benefit, it's called a positive externality. When it's a cost, it's called a negative externality. I think up to Korada.
Together?
Yes. Our cameraman, externalities. Right. So when you suffer negative, he noticed that there are so many parties that suffer from externalities. And he came up with something that is normally known in environmental economics and general economics as the Pigovian taxes and subsidies. And he said when a third party suffers negative externalities, the producer and the consumers have to pay a Pigovian tax. They have to pay some money to the person who was not part of the market, part of the arrangement that suffered the cost of the arrangement. Yes. Now, for instance, in this case, it would be noise.
Yes.
in a neighborhood or something like that.
Yeah.
So you have to pay the Pigovian tax. And then we have the Pigovian subsidies. The Pigovian subsidies was basically for every action that reduces the impact of the negative externality, every action that reduces is subsidized. So for instance, if you're selling, in this case, soundproof things, you're supposed to sell them at a lower price than the market because it is reducing what? The effect of this externality.
Yes. Which in this case is the noise.
Which in this case is the noise.
Yeah.
Now to translate it to environmental studies, it's the same concept. The consumer and the producer produce what's the pollution, the gases that we've been talking about in the whole of this podcast. They produce the greenhouse gases. And who suffers? The person who was neither the producer nor the consumer.
Yeah.
And I'm just going to get a little bit selfish because I come from a developing world and say when the developed worlds were becoming industrialized at that point in time, there was a lot of production of pollution, these greenhouse gases.
Yeah.
And part of the reason why we still have climate change to this very day is that they're still producing a lot of pollution up to this particular point in time. So they're producing it and they're also consuming the benefits of this development. They are developed at this point in time. So they even have tools and resources to mitigate the impacts of climate change.
Yes.
Me, from Kenya, I am a third party. People in Turkana from Kenya are third parties. They are suffering the consequences of the producers and the consumers who are in a completely different world.
Climate change being a global thing.
Climate change being a global thing. Because once the gases get into the atmosphere, they don't care kama ziko juu ya Africa, kama ziko juu ya America. They just suffer. All of you suffer. There's no person that is, removed from that. But if you have tools and resources, you can mitigate the impacts of climate change like that, yeah? We don't. We are neither producers, consumers, neither do we have the tools for it. So by the end of the day, we suffer the negative externalities of the production and consumption of pollution.
Yet our contribution is not as high as theirs.
Yes, yet our contribution is not as high as theirs.
Yeah.
So that is the history of carbon trading and how it happened. So he said that we have to pay the Pigovian tax and the Pigovian subsidies. And that is the whole aspect that when it comes to the ground, every action that reduces carbon in the atmosphere, that gives you, let's say, if you use this natural gas essentially has more carbon impact to the atmosphere, to the environment in general.
Yeah.
If you come up with a solution, if you come up with a product that has less carbon impact, that product is supposed to be sold at a subsidies.
Yes.
Who's supposed to pay for this? The producer and the consumer, who in this case are the developed countries.
Yes, they are.
The developed countries. All right. So now we have gotten that part. Let's talk about the next part, the cap and trade. The cap and trade is the limits of which you can trade at, yeah? Because we said carbon naturally exists in the atmosphere. We also said that people produce carbon in their day-to-day activities. So it's not like a sin to produce carbon, but there should be a limit. So this limit was defined in the Kyoto Protocol of 1997. Bikoro, shine.
So what's a cap? You decide to place a cap on something. Let's take a bottle. Mm-hmm. A cap stops something from going over.
Yeah, exceeding. Yeah.
You close it up. Mm-hmm. So when you're placing a cap on your carbon emissions, you're saying this level don't exceed this level. So if you exceed this level, you're gonna have to the extra carbon you're producing has to be traded. Mm-hmm. You're gonna pay for the extra that you used up or produced above the limit that was placed. Mm-hmm. So you exceed this level, back to the market, you're gonna pay for that.
Yeah.
So that's cap and trade.
Yeah. So when you look back at the Pigovian taxes, it's now we put a number on those taxes. At what point does this externality, or at what point does it become taxed? Mm-hmm. And in the Kyoto Protocol, they came up with all the participating countries, all the member countries of the United Nations Framework for Convention on Climate Change, UNFCCC.
3 C's.
3 C's.
Yes.
That is how we used to remember in exams. It's 3 C's. It's the 3 C's. Yeah. So they came up with a cap for different countries. And just to break it down, so if Canada is supposed to produce 100 units of carbon, and Kenya is supposed to produce 100 units of carbon, just as an example, Kenya produces what Africa in general produces less than 4% of the pollution that is normally by the end of the day that goes into the atmosphere. Yeah. That is where the politics of carbon come in. So they produce less than 4%. And yet the drought, the famine, where is it located? Right here.
Yeah, we have floods. We have the major floods here. We are literally having Sahara. Sahara is the biggest desert in the world. We're having the Sahara here. Yeah, Chalbi was a desert. Chalbi still is a desert in Kenya.
Uh-huh.
We are experiencing that here. Yeah.
Yeah, and yet we have very little pollution by the end of the day. So that is why we call for these things. That is why there was the African Climate Summit.
Yeah.
Try and understand why we are producing, out of all of these gases that we have been talking about, the gases that are in the atmosphere, why our contribution to these gases is only 4%. Yet by the end of the day, when the effects of this climate change happen, we suffer the most.
Yeah.
Remember, all of us suffer.
Yeah.
But they have mitigation techniques.
Mhm.
And these mitigation techniques are the benefits of their production of that pollution.
Yes.
Yeah? So they are taking the benefits and we are suffering the externalities. We're getting the negative externalities. And that is where the campaign and the political carbon conversations happen.
Yeah. I mean, that is not to negate our contribution. Feel like if they come in and they, sort of pay us, I mean, polluter pays, polluter should always pay.
Yeah.
If they sort of pay us, we are gonna just bump up our conservation practices or whatever to deal with the climate change.
Yeah.
We are not negating our
We're not saying that we are not contributing.
We are contributing.
And as a matter of fact, the rate at which we are contributing is getting higher as days go by.
Yeah.
But it is important to say the maths. Africa produces less than 4%.
Yes.
And how are we producing less than 4%? And the people that are producing 96% are seated somewhere very comfortably, not even worrying about climate change. It's very concerning and very annoying, but I will not get passionate.
Breathe. And move on. Yeah.
Back to the cap and trade conversation. Let's go back to the Kyoto Protocol. I was giving an example before I digressed. I was saying if Canada has 100 units of carbon that they're supposed to produce, and Kenya has 100 of units that they're allowed to produce that amount of carbon. If Canada uses up their units and then exits by, like, let's say another 100, they use up 200 units of carbon from the atmosphere, or they release 200 units of carbon from to the atmosphere, they have overpassed their limit, their cap,
100.
by 100.
Yeah.
If Kenya does its thing and uses up 10 units, and it's very common. Actually, this happens every single day, and it is why the cap and trade method was introduced by the Kyoto Protocol in 1997. The Kenya can now trade
They're 90.
her extra units, her 90 in the market, and carbon credits have a price. Right now, it's like, is it $40 to $80, depending on the market at the time. So 1 metric ton of carbon goes for that amount. And now if Kenya has like 1 credit goes for that amount, and 1 credit is 1 metric ton of carbon. So if Kenya can sell their 90, they're in a position to trade. But this trade is not like in the market that you bring your carbon, it has like its own processes. There's processes of verifying this carbon and things like that. But it's important to understand why the cap and trade came in. It's so that we can have a balanced amount of reduction. Like, you're producing this and me, I'm producing this. By the end of the day, we need to allow you to produce this amount, but you also need to allow me to produce this amount.
Yes.
Only when it goes overboard does it become a problem. Yeah.
So that is climate financing.
That is clever. How are you feeling, economist? Okay, let's talk about the process of carbon credits. How does it, like, how by the end of the day do you become verified that you actually have this carbon? Because calculating natural resources and essentially carbon is problematic. So according to the Kyoto Protocol, how would one country say, by the way, we have not used up our carbon, come trade with us? How would it happen?
So we have different organizations that do this, yes? We have different organizations that are, for different countries that calculate these carbon, the credits themselves. So, for example, in Kenya,
we have Vivo Energy, actually. Vivo Energy, they do verification of projects. How they do it is, if you have a carbon project, a project that reduces the amount of carbon in the atmosphere, or provides an alternative that reduces carbon as compared to the one that is in the market. You remember when we said like natural gas and you give us an alternative? So if you have a product like that, you invite Vivo Energy to come and gauge how much carbon you're reducing into the atmosphere. So now when they come into the ground, they verify the amount of carbon, so they can give you carbon credits. They can give you credits. They can tell you have like 50 credits to trade with. Now when you have 50 credits to trade with, you go to the market. You look for businesses, organizations, countries of people who have exceeded the amount of carbon that they are supposed to trade. And mostly when you have verified carbon credits, selling it is as easy as this.
Yeah.
Of course, there are laws that allow, that advocate for this carbon the carbon trading to return back into society. Essentially in Kenya, there's a percentage that the carbon company is supposed to, the company that is hosting this project, there's a percentage they're supposed to take home, and then there's a percentage that's supposed to go back to the community. The pockets of the people, the pockets of the farmers, the pockets of the, and it's supposed to give back to the community. It's supposed to be the one that builds schools, roads, and things like that.
Just for their efforts in not contributing to carbon.
Yes, just for their efforts in not contributing to carbon and also reducing the carbon in the atmosphere.
Yeah.
So there are different companies, you were saying.
We have also the Kenya Climate Change Compliance. This is a Kenyan-based organization. That provides climate change compliance services.
Yeah. So let's ask this question as we wind up in this conversation. If I wanted that money that comes to selling my carbon credits, how do I get it? Because I feel like that's a very important question to have. The first things first, you need to come up with a project that agrees and reduces carbon in the atmosphere. I keep saying it like this. It's very simple. It's either your project reduces carbon, like trees, they sequestrate carbon. they take in carbon. Yeah. If you have a project that is planting trees and you plant enough trees that reduces the amount of carbon, you can now get these companies to come verify you. That's the most important thing. Getting that certification, the carbon credit certification, that translates to the carbon credits that you can trade in the market.
Yes.
That's the first thing. That project must be in the Clean Development Mechanism projects, and it must be under the UNFCCC.
Yes.
CCC. And how you get it there is just basically through verification.
Yeah.
Once it's verified, it automatically becomes one of those projects under that. And then now you tell this person, we are producing this amount of carbon, right? In this place, we are sequestrating this amount of carbon.
Yeah.
Every single time we sell, for instance, our GICO, for instance, every single time we sell our GICO, this is the amount of carbon we are reducing. We are risking to reduce from the atmosphere because the alternative would give this.
Yeah.
Once you have that actual number, you can now sell it.
Yeah.
And you can sell it to a country, you can sell it to an organization, you can sell it to a business within Kenya, without Kenya, and all over the world.
Yeah.
Now, once all of that is done, the carbon credits are retired. So kama ulikuwa na 50 credits, ukishaziuza, hizo unasahau stories zake. You start up another project. That is how you can make money through carbon trading. As individuals and as it's a little more hectic to do it as an individual, but you can have so much impact as if you do it as a community. So you can get your community members together. You say that part of our farmland, we're going to use it for carbon trading.
Yeah.
We're going to plant trees. This project is going to be called this and this. Get a company that is going to verify your carbon credits. And then once the company has verified your carbon credits, you sell them, retire them, get the money, change your life.
You have contributed.
You have contributed, and you've also taken part in the trading.
Yeah.
It is important to note as we wind up that trading, the one I said, the Pigovia taxes, why the trading has to come from developed countries to developing countries is that because by the end of the day, we are suffering the externalities of consumer and production. And I said, yes, we have produced, but Africa produces
not produced as much.
4%. As a continent.
That is insignificant compared to what they have produced.
Exactly. It's 96%.
Again, not trying to negate our contribution.
We are really polluting. These Kenyans, I know them.
They're really coming up. But if they give us an incentive to bump up our conservation practices, then I feel like we're going to be
inspired. Yeah. So basically, the money that comes in this carbon is supposed to help reduce the carbon in the atmosphere.
Yeah.
So there are also other like joint mechanism projects, joint implementation projects, clean development mechanism projects that come in. So we have like developed countries bringing in a clean development project, like a renewable energy project in Kenya. That is another way that they pay. That is another way that we trade in carbon. So we could have this discussion up to tomorrow because we're environmentalists and we love the discussion on carbon trading. But essentially that is the discussion that we were having in the African Climate Summit. Thank you for joining us at Evaluation. Please keep checking out our previous podcasts if you have not seen them and the ones that are coming after this one. Bye.
Lovely series. Let's meet again. Yeah.